Perfect. So taxes in retirement. Let me start by saying I think this is a topic that we see get overlooked by a lot of people. Um, and I think one of the reasons why is, in your working years, taxes are fairly easy, right? Like you have a salary, it's X amount of dollars. Most people know if you put money into a 401k or 403b, 457, IRA of some sort, maybe a TSP. You're reducing your income, and therefore you're reducing your tax liability come springtime. And I think what people come to realize later in retirement is, you go through this whole period of wealth accumulation. You spend the majority of your life in this wealth accumulation phase, and then all of a sudden you hit this spot where it changes from wealth accumulation to wealth preservation and wealth distribution. And the latter, it's a totally different animal from a financial planning perspective, tax planning, investment planning. And I think that's why sometimes it might get overlooked. And we feel that tax planning in retirement, it's probably one of the biggest value adds that an advisory group can bring to your retirement plan. We definitely feel like this is a big strength of what we do. We've had a number of clients that end up working with us, and that they'll tell us after the fact, but solely because of this tax planning piece. And now we work with a lot of CPAs, and in terms of CPAs, like that there are a lot of really good CPAs, but one of the things we find is many times they're looking at the previous year, maybe 1 year ahead, and spending very little time looking 5, 10, 15 years out what your tax picture might look like. And I think kind of that forward-looking tax planning is a really big piece that you should be considering if you're not already. And hopefully, this next hour or so will bring some clarity to that. So let's see. All right, start with this disclaimer. Through this webinar, Oceanside Advisors does not offer to render personalized investment or tax advice. Information provided is for informational purposes only and does not constitute financial, tax, or legal advice. Now, of course, we would be happy to give you this type of advice, but we need to know you better, right? Like we can't give you tax advice without seeing your tax return and knowing exactly what is going on there. So, of course, we'd like to talk to you about those things, but. All right, I'm going to start off with a bad joke. I took this slide from, actually a handful of these slides I took from the last tax presentation I gave, about a year ago. What do you think these people are doing? Taxes. Usually I get a couple giggles. It's too bad this is a one-way audio. It's not a good joke. Maybe I didn't get any, but taxes, right? So this is a question too difficult for a mathematician. It should be asked of a philosopher. When asked about completing his tax return, who is this? Albert Einstein. All right, and obviously pretty bright guy, and he was confused by taxes. I don't know exactly what the tax code looked like back then, but I would be willing to bet that today's might be more complex. I don't know, I could be wrong. All right, our goals today. First of all, we're going to understand the basics of personal taxation and relevant changes of recent legislation. All right, so we are going to start with the basics. So those of you that already have a solid grasp on the basics, maybe go pour yourself a cup of coffee and come back in 5-10 minutes. But some of these other things that we're going to be going over, these other topics, they aren't going to make a lot of sense to those that don't have a basic understanding. So we're just going to take a few minutes to go over personal taxation basics, kind of the way it works, and then we're going to go into some of this legislation change over the past 3 or 4 years. All right, so Tax Cuts and Jobs Act, of course, this is the legislation that passed in 2017, went into effect 2018. Then we're going to touch on the Secure Act. So that was the sweeping changes, many changes with retirement planning and estate planning implications. That was passed last year, 2019. And then, of course, with the coronavirus and the stimulus measures, the CARES Act of 2020 also has a handful of retirement planning implications. So we're going to look at some tools and strategies available to retirees. We're going to avoid the political, stick to the actionable. All right. So obviously, 3 big legislative changes here. So maybe someone that thought they understood taxes 3 or 4 years ago, if you haven't looked at it in a while, you might be surprised to learn a couple things today. All right. Okay, so starting off here, married filing jointly. This is the 2020 marginal tax brackets. All right, oops, not ready for that yet. Just trying to get my pen out here. All right, so in the United States, of course, we have a progressive tax system, meaning the more income you make, the higher taxes you pay, right? And I think most people understand this, but just to be clear, say for example, you make $200,000, like you don't pay 24% on the entire amount. Okay, the way it works is you get to start up here. So the first $20,000 of income, you pay 10%. This next 60,000 or so, you pay at 12%, and so on. So when you get up here, really you're only paying 24% on the income between 171,000 and 200,000. Okay, so these are ordinary income brackets for 2020 for those married filing jointly. All right, when we look at tax brackets, you're going to see us looking at screens like this more today. We call this a tax map. Okay, so it's really the exact same thing we were just looking at, with the exception of, you'll notice this little hole right here. And what this is your deductions. Right, so the purpose of this tax map, we're just using a standard deduction, and then everything else just kind of builds off of that. So this is called a tax map. You're going to see a lot of this today. Now in the tax map, you'll notice there are a couple big jumps here. All right, from 0 to 10, of course, is big. 12 to 22. You get a third one right here, 24 to 32. And many times, not all the time, but many times, some of the biggest tax planning opportunities come in these ranges. All right, so just something to keep your eye on. All right, so it's not just ordinary income. We also have what's called long-term capital gains, qualified dividends. These are taxed a little bit differently. All right, so similar concept to ordinary income, where only the amount above the threshold is taxed at the higher rate. All right. Prior to the Tax Cuts and Jobs Act, these brackets were linked directly to ordinary income. Now it's a little bit different. They stand alone. Okay, it looks like this. All right, so there's actually a 0% capital gains bracket of taxable income less than 80,000. And then we see a lot of people fall in that 15% range, and then capital gains are capped out at 20%. One piece to add here, just to make sure we're clear again on the basics. Again, taxes are tricky. Taxes are tricky, but what you need to do before you calculate your capital gains, you actually have to add your ordinary income in here first. So for example, like if you have $60,000 of ordinary income, like that would fill up the first 60 of this bracket, right? So in other words, after that 60,000 of ordinary income, that would mean that you have 20,000 left that you could potentially realize capital gains and recognize those at 0%. All right, so again, going to our tax map, this is what our capital gains and dividend tax map looks like. All right, so again, we're adding a little standard deduction, and then of course that next 80,000 is the 0% range. All right, so then we have, you know, deductions, exemptions, credits. What are deductions? All right, so these are, well, simply an amount deducted from your taxable income, right? In 2020, you have a standard deduction if you're married filing jointly of $24,800. If you are single, $12,400. Okay. Many people, when they turn 65, they're surprised to see that you get an additional $1,300 if you're 65. So what we see a lot with you know, a married couple later in retirement, you get $1,300 each here for $2,600, and then you add that to standard deduction here, which for this year, $24,800. So for the year 2020, we're going to see a lot of standard deductions of $27,400, right? And of course, these standard deductions went up a lot. They increased a lot in the Tax Cuts and Jobs Act. So they used to be about half that. All right. Now, the alternative to taking the standard deduction is if you itemize. Right, and this is a concept that some people have a hard time understanding, but you only get to do one of them, right? So you're going to end up doing whichever one's higher. So itemized deductions show up on your Schedule A on a tax return. And what is included in itemized deductions, these are the four that we see most often. That there are you know, a handful of other ones, but any kind of mortgage interest that you have on debt up to $750,000, charitable gifts, all right, up to 60% of your income, all right, that's usually the rule. However, as a part of the CARES Act, right, this coronavirus stimulus bill, for 2020, you could actually deduct your entire income, right? Of course, the government is trying to incentivize and encourage charitable giving to, you know, some organizations that are trying to fight this thing. Right, another itemized deduction that we see a lot are these state and local property and income taxes. Now, again, as part of the Tax Cuts and Jobs Act, that this is now capped at $10,000, right? So in South Carolina, of course, extremely low property taxes. It doesn't impact as many people as, you know, we have some people that we help up north in some higher state tax areas where, you know, but before they were deducting, you know, tens of thousands, sometimes even hundreds of thousands in deductions here in you know, income and property taxes. So that this was definitely a point of contention in those states that have higher tax rates, because now those are capped at 10,000. The other itemized deduction we see a lot, or not a lot, this one, because it takes a pretty tough year, but, you know, medical expenses in excess of 10% of your AGI, adjusted gross income, AGI, that's what that stands for. Now, so just a really simple example, if your adjusted gross income is $100,000, you can't deduct medical expenses until they are, you know, exceeding 10,000, right? So if you had 12,000 in that year, you'd be able to deduct 2,000 of that. Now, a couple of years prior, that used to be 7.5%. Now that's 10. But the point being, like, so that the sum of all these, you know, that it needs to be more than these standard deductions up here. Otherwise, you know, for a lot of people after this, you know, Tax Cut and Job Act, it's only like 12% of taxpayers itemize anymore. Right? It takes, you know, quite a bit of deductions to get up to that. You know, for many people, $27,400 of deductions. Oh, one point I will add, and again, there have been so many changes, and trying to package this entire webinar into 1 hour, I really struggled with this, because like this, you know, taxes, like this is a topic I could chat about for probably 10 to 12 hours straight, these different topics. So in no way is this hour or so, you know, an exhaustive list of everything going on. So like one thing I just thought of right now, you know, another part of the CARES Act, even if you do take the standard deduction up here for 2020 alone, all right, part of the CARES Act, you can have a charitable deduction of $300 to include up here on top of your standard deduction. All right, so maybe you don't have enough deductions to itemize, but you're still charitably inclined. You know, you want to help somewhere. This year for 2020, you can actually include $300 as a, you know, an above the line deduction for your tax return. Glad I remembered to say that. That's all right. All right, so exemptions, you know, we used to have these things for being alive, right, gone, right? So there are no more exemptions, right? The Tax Cuts and Jobs Act that eliminated that. So no more exemptions. Credits, there's a handful of credits. The difference between credits and deductions is, so deductions, again, you're taking off your taxable income. Credits you apply after you already have your tax bill. Right, so if your final tax bill, and we'll do a quick example of this, but if you have your final tax bill and you know you would have owed $2,000, if you have $2,000 worth of credits, you know, you can wipe it out clean. So incentivized behavior, some people get healthcare tax credits, earned income tax credits, education savers credit, child credit. Many of these are based upon your adjusted gross income. So at higher income levels, you know, you may not apply or may not be eligible for some of these. So just a really simple tax calculation here, and then we're going to get into some more complex items. So here, just gross income, let's say 38,400. Then again, that standard deduction we touched on earlier for 2020, 27,400. Right, so if we just do some simple subtraction, 38,400 minus 27,400, we have $11,000 of income if it ended right here. But then we're gonna have an IRA contribution, so that's an above line deduction. So we get to take 2 off there, which would leave us with $9,000 subject to tax. All right, this would fall in the 10% tax rate. So we would have a $900 tax bill, but this person would have been eligible for a credit for the IRA contribution, therefore owed nothing in taxes. Okay, so you just kind of see the difference between deduction to calculate your tax bill, and then how credits come in after the fact to reduce or at times eliminate the tax bill altogether. All right, now it would be easy if taxes were that easy. The real tax system, that there's a number of other factors that make this more complex. All right, so required minimum distributions, you will hear me refer to these many times as RMDs. All right, so capital gains, right? So that might be from investments or from real estate, can be a number of things. Social Security benefits, All right, we're going to touch on how those are taxed. By the way, these, yeah, of course, I'm working from home today, and at times I'll have these, we have cats in our house that are making noise over here. Hopefully you can't hear them. But Social Security benefits, right? Very confusing the way that these are taxed. We're going to go through an example of that. Medicare premium surcharges. Okay, so at different income levels, your Medicare Part B and Part D become more expensive. So you need to be, you want to be aware of where you sit. Potential Roth conversions or large withdrawals from IRAs. All right. There is, through the whole Affordable Care Act, Obamacare is, part to fund that program. There was a 3.8% net investment income tax that gets put on higher earning individuals. So something to be aware of there. We'll touch on that very briefly, as well as the alternative minimum tax. Now, with the Tax Cuts and Jobs Act, this applies to very few people now. Okay, just given some of the changes they made, capping, the state and local taxes. So we're not going to actually touch on the AMT at all today, but certainly if that applies to you, we can talk about that in more detail. All right, so let's start with required minimum distributions. All right, and how do they work? Well, the IRS is going to require taxable withdrawals from retirement accounts. Right, so again, if you're on the webinar at the beginning of the call, many times throughout your earning years, you are deferring income into pre-tax, deferral accounts. So that might be traditional IRAs, SEP IRAs, 401ks, 403bs, 457, TSP, if you're involved in government work. And now this has changed a lot. So a lot just came on the screen here. The way it works now, right, or at least going forward, the year you reach 72, you are required to start taking money out of your qualified accounts. All right, now this just changed from 70 and a half in the Secure Act that was passed last year. All right, now, I know this is a lot. Okay, so with the CARES Act, all right, so 2020, which just passed, the stimulus measures a few months ago, there are no required minimum distributions in 2020. All right, so that whether it's your own IRA, whether you have an inherited IRA, there are no RMDs for 2020. And the thought there is, of course, with the market earlier this year being down significantly. I mean, obviously it's still down a good bit, but well off the lows. I don't know, Congress felt it would be unfair to, maybe unfair is the wrong word, but they just thought it would be tough for making taxpayers withdraw these RMDs based on, because remember, RMD is based on the previous year's, your December 31st account balance. Market was pretty high December 31st of 2019, right? So because your RMD is based on that number, and then the market's down a bunch, they kind of gave retirement, account owners a pass here for 2020, right? So again, I just touched on this, but how do you calculate your RMD? Well, you just take the prior year's ending balance. The IRS has a table, it's called Table 3, and it's just it's your remaining life expectancy table. All right, so we're going to show what that looks like on the next slide, but all you do, if your IRA balance, call it $500,000 here in this example, this is for a 72-year-old, 25.6 is the factor on that Table 3, would require a distribution of a little less than 20,000, right? So RMDs start off about 4% when you're at age 72. Now, important note here, what a question we get sometimes, what happens if I forget to take this RMD? What happens if I calculate it wrong? And the answer to that is that is not good. Do not do that. It is the strictest penalty in the entire tax code. Penalty is 50%, 50. Okay, doesn't get much worse than that. So yeah, maybe you, you know, in this example, you forget to take this distribution. Yeah, you're going to be looking at about a $10,000 penalty, and the IRS is not nice. You can go in and try to fix it, but just I would encourage you, don't put yourself in that mess. Make sure you're calculating your RMDs correctly, which again, we could do a webinar, probably a half-hour webinar just on that alone, because that gets confusing whether money's in 401ks, IRAs, or inherited accounts. So make sure you're doing that right. Okay, so again, on these RMDs, so how does it start? Okay, so let me get my little pen out here again. As you can see, like, you know, as you're getting older here, so here's the one we just calculated, right? So age 72, you're just going to divide your balance by, you know, about 25. So that ends up being, RMDs start out at about a 4% withdrawal rate. Of course, you get older, right? You keep getting older, you get in your 80s, and now all of a sudden your factors are a lot less, meaning you've got to withdraw a lot more money. And so this is something that I think a lot of people, we see it all the time, but people aren't quite prepared for what this can do to you from a tax standpoint, right? Because at age 72, it's 4% of your account. But when you are, you know, in your mid to late 80s, it can be, you know, it's going to be closer to 10% of your account. Okay, and so something we want to talk about here is that this is where we really encourage people to consider and at least do the proper analysis. You know, do Roth conversions make sense for you? And now we do Roth conversions for people that are, you know, already taking RMDs, but really the best window and where the majority of opportunity presents itself for Roth conversions, right? It's usually right when you retire until you have to start taking RMDs. All right, and I just want to give a quick example here of just try to illustrate this point. All right, so again, here we have the ordinary income tax map. All right, just for income between 0 and 150,000. All right, so the way this works, let's say this couple, you know, just retired, age, let's just say they're both age 66. So they both, you know, just started their Social Security. All right, so let's say, let's just say their Social Security, their taxable Social Security, which we're going to get into in a little bit, but let's say their taxable Social Security is $40,000 between the two of them. All right, so what a lot of people do, they get to retirement, and unfortunately, you know, they think, okay, you know, here, yeah, I know I don't have to withdraw from my retirement accounts until, you know, 72. So, you know, maybe I'll let those just sit there. I'm not really going to think about them until later on. You know, maybe I'll just early in retirement, I'll just live off of Social Security, maybe some savings, other non-qualified assets. Because so let's just say that's the case for this couple. They kind of have that mentality, and they know a future, you know, future income's going to. So in this case, let's just say they have $1 million IRA between the two of them, you know, in total, and therefore, you know, again, going back to that 4%. Remember, RMDs when you turn 72 are about 4%. So, you know, let's just say, you know, so that would be a $40,000 required minimum distribution at age 72. So they might be sitting here, you know, thinking, all right, we're living off of savings, this $40,000 of taxable Social Security, but we know someday we're going to have to recognize another $40,000 of ordinary income when the IRS makes us take out money from, whether it's an IRA, 401k, any of those other qualified plans. Right, so you see, right now they're in the 10% bracket. You see this little nudge up. Really, they're sitting at the 12% federal bracket. And now here's the potential problem here. Having flexibility, and when I say flexibility, and we'll get into this a little bit more later, like it really helps in retirement planning if you have Roth IRA balances, non-qualified account balances, and of course, most people have IRA balances as well. But the more flexibility you have between those three buckets, the better off you're going to be. All right, because what can potentially happen here, again, assuming that they're fortunate enough, they're blessed enough to live a long life and they live into their 80s, what they're probably not considering is, right, so RMDs might be right here starting off, all right, but yeah, let's just assume that account stays relatively flat. So that $1 million, while that's a 4% withdrawal here when they start, remember later in life it's closer to 10%, right? So if now so 10%, so on a $1 million IRA, yeah, that's going to be a $100,000 distribution, right? So now all of a sudden they're way out here in the 22% tax bracket, and they're gonna be out here the rest of their lives. Okay, now again, this doesn't work for everyone. It doesn't make sense for everyone to do it, but everyone should at least do the analysis and consider it. All right, what we would, let me find the eraser here. What we would want this couple to do, at least consider. Okay, so again, they're age 66 right now. They're age 66. So we're gonna say, wow, that's a 6-year window before the government's gonna start taking out, forcing you to take money out of your account. What if we start recognizing some income today and convert it from traditional IRA over to your Roth IRA? Okay, and by the way, you don't need a Roth IRA opened already. Like we're not talking about contributions, Roth contributions. That's different. These are Roth conversions. The only thing you need for this is an IRA balance or a 401k balance, right? So we would say, what if we looked at the tax map here? We don't want to convert. We don't want to convert a substantial amount of money where we're sending you up here to begin with, but what if we look at this and we say, hey, Mr. and Mrs. Smith, you're likely in the lowest tax bracket you're ever going to be in. You've got a nice runway here at 12%. What if we convert $60,000, right? So that'd bring here. Well, what if we convert $60,000 from your IRA over to your Roth IRA? Right. So, of course, we're going to recognize that income. So you're still in the 12% bracket, right? So this is years 66, 67, 68, 69, 70, 71. Okay. So basically we'd have 6 years. We'd have a chance 6 years to convert $60,000. Okay. All right. So what this would give us, and I realize this is a very simple example, just trying to make a point here, but we're just going to assume zero investment growth or decline in these periods. Okay, so this couple, all of a sudden, they're going to have $360,000 in a Roth. All right. Now, so if we do that for 6 years, they're going to have 360,000 in a Roth. Now, that alone is wonderful, because now you're going to have a tremendous amount of flexibility later in retirement to tax plan. But what a lot of people forget is the benefits of you reducing your current IRA, right? Because you're reducing your future, the dollar amount that you're going to be forced to take out of your RMDs, right? So again, just assuming no investment growth, that $1 million IRA, right? We've taken that from 1 million from these conversions because we've converted, 60K for the last 6 years. So now this IRA balance is down to 640,000. Now, why is this awesome? Well, for starters, your beginning RMDs are going to be less, right? So you're going to be 4% of that, so you're going to be less. But now think ahead to when you're in your 80s, when you're in your mid 80s. What do your RMDs look like now? Well, now, if we're taking 10% of this, so 64,000, like you might have avoided this 22% bracket altogether, right? Because we go 40, 64, so we're at $104,000. like you would probably fall somewhere right in here, right? So later in your life, like you might never see that marginal tax bracket. Okay, so that's kind of what we're thinking in terms of forward-looking tax planning. Like you can't just be looking at your tax liability today or next year. You really want to spread it out over your entire retirement and do a proper analysis.
Johann, you mind if I jump in for a sec here? One more point.
Please. Yeah, please.
One really important thing to point out and I think you mentioned this earlier, that the tax reform is set to expire in 2025. So right now we're working on the tax brackets that we currently have. And obviously we're not fortune tellers. We don't know what the future holds, but I would expect that taxes are as low as we can expect them to be. I don't see them going lower in the future. So that 22% bracket that we're worried about hitting could be a 32% bracket in 6 years. We don't know that, but I think we're pretty comfortable with where they are currently. And if we can, eliminate the size of our RMD down the road, I think it's definitely something worth it, at least, taking a look at.
Great point. Thanks for jumping in.
Yeah.
Perfect. All right. So moving on to Social Security. This is confusing. A lot of people don't understand how Social Security is taxed. So it's based on what's called your provisional income. All right. So what makes up your provisional income? All right. Well, you start with 50% of your Social Security benefit. All right. So you just, whatever your gross benefit is, you take half of that. All right. Then you add in any ordinary income that you have. Right. So ordinary income, that's everything. That's if you're still working part-time and you have wages in a W-2 or 1099, any IRA withdrawal from a traditional IRA, 401k, all that would be included here. They're also going to add in any dividends and capital gains. Lastly, they even add back non-taxable interest. What's this? This is like municipal bonds, right? So you can escape federal income taxes at times, but then they come back and get you for your Social Security, right? So you add up, the sum of these four components makes up your provisional income, right? And why that's important. So to figure out how much of your Social Security is deemed to be taxable income, all right? Again, I married couple here, but the rates for married filing jointly. Let me start by saying if your provisional income is less than 32,000, 0% of your Social Security is taxable. So you get your Social Security tax-free. If your provisional income is greater than 32,000, that's where your Social Security begins to be taxed at 50%, like 50, not a tax rate of 50%, but 50% of the dollars that you receive become taxable, right? And then anything over 44,000, that's where 85% of your Social Security dollars become taxable. So just a quick example. So So here we have an individual or a couple where we have $20,000 of Social Security, and then we'll say that they also have $40,000 of an IRA withdrawal. All right. So again, going back to that provisional income calculation, we're only going to include half of the Social Security, right? So 10,000 there, 10,000 plus 40,000. They're going to call this 50,000 of provisional income. So the way your Social Security gets taxed, right? The first step here is find out how much of your Social Security, how much of that income doesn't make it up to the that 32,000, that first threshold, right? So that first 32 we aren't going to include. So let's find how much is over that amount, right? So 50,000 minus 32. They have $18,000 of income above that first threshold, right? We just saw in the previous slide, income above 32,000 is going to 50% of it, right, is going to be included as taxable income, right? So take that by 0.5. So we have $9,000 of $9,000 is going to be considered taxable. Now with this couple, remember they're at 50,000 in provisional income, right? So they also have a certain amount of income that's over this second threshold. So to figure out, the second threshold, $50,000 minus 44,000 is a second threshold. So they're $6,000 over that number, right? So we know that the second threshold is 85% of income, right? So we just need to calculate what's 35%, right? So we already took the 50% in this previous box, so now we just need to add in that next 35 to get us up to 85% on this bucket, right? So this calculation, $2,100. So therefore, someone in this situation, $20,000 Social Security, $40,000 IRA withdrawal, $11,100 would be considered taxable. All right, now for just to show the importance of like this ratio between your Social Security income and your other income, and why provisional income is so important, right? So here we have someone like they too are receiving $60,000, right? So remember example one here, this is 20,000 Social Security, 40,000 IRA withdrawal. So it's $60,000. Example two, this person also is receiving $60,000, but just the other way. So they have, instead they have 40,000 Social Security, 20,000 IRA withdrawal, right? So again, provisional income calculation, we start with half of your Social Security. So we're only going to include 20 plus this 20. We got to include the entire ordinary income, $40,000 of provisional income, right? So doing the same calculation we did last time, now we have $40,000 provisional income. First determine, how much do we have above that first threshold? So we have $8,000 of income above the $32,000 threshold. Of course, that income is going to be included as 50% taxable, right? So $4,000, and then you'll notice in this case we have no provisional income in excess of 44,000. So this person would have zero in the 85% space. Therefore, this person's total taxable benefit would only be $4,000. Okay, and then to see the way this might play out potentially on a return. All right, so again, here's example one is in the left column. So here's the person that had 40,000 IRA, 20% or 20,000 Social Security. So we just calculated this taxable Social Security from the last slide. $11,100 there. Remember, we have to include the whole IRA, of course, in any kind of in any ordinary income. So total taxable income here, a little over 51,000. We'll use 27,000 standard deduction. Right, so 51, minus the 27 here, net taxable income a little over 24,000. This person's going to end up paying federal income tax around $2,500. Whereas example two, right? We calculated last slide only 4,000 in taxable Social Security. There's the $20,000 IRA withdrawal, total taxable income, 24,000. Same standard deduction, 0, right? Because the 24, oops. So 24,000, of course, you put the standard deduction on top of that, and it totally wiped it out. So the people on the right here paying no income tax. People on the left were paying income tax. Now, practically speaking, like how does this apply to you? Like, do you have control over the Social Security income that you receive? To an extent, right? Like your Social Security filing strategy, when you file, what spouse files first. You do have some control over that. You certainly have more control over your withdrawal strategies from IRAs, right? So just understanding the way your provisional income is going to stack up, because sometimes, right, like in this first case, example 1, like maybe this person, instead of drawing $40,000 from an IRA, maybe they could have only withdrawn 10,000 from an IRA and used 30,000 from a Roth they already had, or 30,000 from some other savings account, right? If they would do this, like far less tax. So something to consider there. Okay, not going to spend a lot of time on this, just because I think wow, this is going again. I get talking about taxes. I was going to try to keep this close to an hour. Hopefully, yeah, I got to keep moving here. So net investment income tax, again, this is what funds the Affordable Care Act, or part of it anyway. So 3.8% tax on investment income for individuals and married couples that earn over $200,000 or $250,000. Okay, effective marginal tax rates. All right, so how much of your last dollar do you actually lose to Uncle Sam? Like this is where it gets interesting. I mean, hopefully you thought what we've done so far is interesting, but I think this is where it really gets fun, because taxes are so much more complicated than just looking at your marginal income tax rate, right? Like, because when you look at the effective marginal rate, this is going to include all the different tax pieces, right? So it's going to throw in your Social Security, capital gains. So, for example, like we already saw this tax map, right? We brought this up earlier. These are just standard federal marginal income tax rates for ordinary income. Here's just your standard capital gains tax map for 2020 as well. But let's just do a really quick case study to see what this looks like. Okay, and that's why I underlined like the real system. This is the way things really work. All right, so here you have John and Jane, married, filing jointly, 65 plus years old. And why I say that, that's just so we get the full standard deduction. So they might be 72, 74. All right, we're gonna say this couple has $60,000 of combined Social Security. Let's say they had $15,000 of long-term capital gains. And between the two of them, let's say the required minimum distribution, 45,000. So again, it's probably right in that range again, right around, depending on their age, it could be right around $1 million IRA. All right, now, what would you guess this couple's tax map would look like? All right, what if, just look at these figures. I mean, these are for a lot of people, a lot of people fall in this group that we tend to help, in these ranges here. What if I told you their tax map, it actually looks like this? All right, so this is the real taxes. This is the way taxes work many times. I'm also going to point out here that every single person is going to have a unique tax map. Okay, again, depending on the way your provisional income falls. So depending on the amounts of Social Security, if you have pensions, if you're withdrawing income from retirement accounts already, if you have long-term capital gains, if you don't, like you know, the percentages of those different things that are making up your income. Like everyone, you know, there's not two people watching here that are going to have an identical tax map. All right, so this is what John and Jane's tax map looks like based on that data that we just gave. Okay, so what, you know, the question that we, you know, get a lot is like, well, I wouldn't have thought that, but like, what is this? Like 50% tax rate? Like that, this isn't even a lot of income. Like this is, you know, right in the $45,000 range. It goes from about, in their case, from about $43,000 to about $53,000. Like 50% effective ordinary income rate. And we see this all the time. And I'm going to show you why and how this happens. Okay. All right. So 49.95%. Like, how did this happen? All right. So what intuitively should happen, right? You let's say they would withdraw $1,000 additional IRA withdrawal, right? Like intuitively, we saw that they sit, you know, right in that 12% federal marginal tax bracket. Like you would think, yeah, I withdraw $1,000, I'm going to owe 120 more in taxes. It's not the way it works. If for this couple, here's what actually happens. All right. So what we just went over, right? So this is the intuitive portion. Right? You have $1,000 IRA withdrawal in the 12% bracket. There's your $120 tax liability. Well, what this is also doing is you're causing $850 more of your taxable Social Security. So $850. Remember, so they're in that bracket right there where additional income, every dollar of income is going to fall into that 85% Social Security bracket, right? So now you have $850 that's also getting taxed at 12%, right? So now you have $102, right? Then what you also have, you have over $1,850 of capital gains that are now taxable. Remember, because in that spot of the tax map, that's where, after like a standard deduction, your capital gains would have otherwise been zero, right? Where now, because we've realized an additional $1,000 and we've crossed over into that 15% range, well, now all of a sudden, a portion of that capital gains is going to be included in taxes, right? We know capital, so they're getting taxed at 15% on there, right? So this little $1,000 additional withdrawal, and how often people probably do this without any idea that $1,000 is actually going to end up costing them $500 extra at the end of the day in taxes. We see this a lot. We see it a lot. And remember, keep in mind, like that was just $1,000. Remember that was a window of, from like 43 to 53. So in other words, like if this instead would have been a $10,000 withdrawal, you're looking at a $5,000 potential tax liability, right? So this is why we always emphasize the importance of knowing where you fall each year in your tax map, because I bet you if this individual or person would have known where they sat in the tax map, they probably would have taken that $1,000 from savings, right, or some other account where they weren't going to be in the 50% effective tax bracket. Okay, Medicare excess premiums. So important to know, and this, we see this a lot, especially for the people we help in the higher income tax brackets. But yeah, Medicare Part B and Part D become a lot more expensive as your income increases, right? And important to note here, unlike marginal tax brackets where you pay the lesser amount on the smaller tax on the lesser amount, and then once you reach that threshold, then you start paying the higher rate. Like that's not the way it works with Medicare. Medicare, if you go $1 over, your entire Medicare just became more expensive, right? And it's kind of confusing because it actually goes into effect 2 years after you hit it, but these are big differences. So for example, like maybe an individual here is sitting at 217,000 of income and they have no idea. And kind of like the last example, maybe they, I'm going to make a $2,000 withdrawal from my IRA. Well, just that $2,000 brings you from 217 to 219, right? So then now you're falling in here and you pay this entire amount instead of paying this entire amount. And now these premiums, this is per person, right? So if this is a husband, wife, that's $1,000 more each. So that's $2,000. We call them penalties, right? Because that's a tax planning mistake. That's a penalty. So that'd be $2,000 more just for your Part B. Then on the Part D, the prescription drug side, that's like $500 really, if you go times 2. So that $2,000 withdrawal right here, that might have cost you $2,500 in excess Medicare premiums, and totally avoidable if you know where you sit on your tax map. All right, here's a real life example of actually a Roth conversion, one that we just analyzed last week. But here is, not surprisingly, this big 100% spike. Like that is your Medicare surcharge level. So that's like the first one coming in here for this couple. So this is one that we put in, and for them, we were again, they were looking to do Roth conversions, but in their case, they're trying to get some more flexibility in their Roth account, and this was the only thing we were looking at, right? So when you're doing Roth conversions, of course, this comes into play. You don't want to hit the next Medicare spike. So this is what it looks like kind of in practice, where we're going back and forth between no conversion and a $35,000 conversion. So in practice, that's kind of what it looks like. All right, so tools for tax control. Thank you for staying with us. We haven't lost anyone yet. Tools for tax control. So, I touched on this earlier, but diversify among account types, right? So the more flexibility you have, the more the ball's going to be in your court in terms of tax planning. So IRAs, Roth IRAs, make sure you're at least analyzing if Roth conversions make sense for you, building up those Roth balances early in retirement once income levels are lower. And then of course, non-qualified taxable accounts, that could be brokerage accounts, savings accounts. Okay, obviously properly blend withdrawals from different accounts, right? And again, you have to know your tax map and be aware of the way to do that best over time. Consider which asset should be held in which account. Okay, so this is more of a tax efficient investing point, but just even the investments you should hold in an IRA are likely different than the investments you would hold in a Roth IRA. Could do a whole webinar on that topic too. Analyze impact of Roth conversions and tax loss harvesting. We haven't even touched on tax loss harvesting. I know we have in previous webinars, like briefly, but of course, any kind of harvesting you do, right? If you can reduce your income $3,000 with old, losses from long-term capital gains, you write off those $3,000 of ordinary, like that plays right into your tax map, right? That's going to move. That's going to move that tax dot to the left, right? So less income. So that helps if you can do it. We also, consider bunching itemized deductions. So this is just a high-level tax planning strategy where, let's say, you have considerable itemized deductions, but you don't quite break through your standard deduction, right? So what that means is, let's say, for example, you give, let's say you have $10,000 of mortgage interest, you have, 10, let's say you can max out, so $10,000 of the state and local property taxes. So you have $20,000 there. And typically you give, maybe you give, $7,000 to some, charity. Okay, well, 10 mortgage interest, 10 in taxes, 7 in charity, that's 27,000 itemized deductions. Well, if your standard is 27,400, like it's not doing you any good. But what if instead you said, all right, this year, so just for this year, if I usually give $7,000 to charity, I'm going to give the next 4 years worth of charitable contributions this year. All right, so in other words, I'm going to give $28,000 of charitable contributions this year, and then I'm just not going to give any the next 3 years. Right, so now you're going to have $28,000 of charitable contributions. You add in the 10 of mortgage interest, the 10 of taxes, right? So now you have $48,000 of itemized deductions for that 1 year, right? So you get a much bigger deduction, and then the following 3 years you're just going to take the standard deduction, right? That could be a huge tax savings doing something like that. So that's just a really basic example of what bunching itemized deductions would mean. Last point, using qualified charitable distributions. All right, so qualified charitable distributions are a great way to reduce your taxable income as well as satisfy your required minimum distribution. And it's the IRS is pretty strict how you have to do this. You have to give your charitable distributions directly from your IRA, so it can't touch your hands. You have to set it up for your custodian. So we use TD Ameritrade or Schwab. So you set it up where TD Ameritrade or Schwab is sending it directly to your church or whatever your charitable organization is, and therefore it reduces it's an above the line deduction, so it reduces your adjusted gross income, and it counts towards your required minimum distribution. All right, now you can't do this until you're 70 and a half years old. What's nice is when the Secure Act came through and they moved when they moved required minimum distributions up from 70 and a half up to 72, they left this alone. So you can still do this at 70 and a half. But again, something for your consideration and, for you to analyze, see if that makes sense for you. Okay, last point. Yeah, we're not a little over an hour. Okay, last point, and this is a so-called widow's tax, and another just tax planning in retirement item that I think a lot of people overlook, and it's important you see it. All right, so here you have a husband and a wife in retirement. All right, so the husband's security $2,000, the wife is $1,000. The husband has a $3,000 pension, and they've been withdrawing $2,000 from his IRA. So of course here we have $8,000 of total monthly income. All right, so $8,000 of monthly income. That turns out to $96,000 a year of income. So total tax on that kind of income would be a little shy of $8,000. Tax rate, effective tax rate, you're going to be about a little over 8%. All right, so what can happen here is, let's say tragedy strikes, life happens, tomorrow's never promised. Look what can happen here. So first thing to point out, so let's say that the husband passes away. First thing to point out is the IRS isn't very nice with this. If you lose your spouse, like the next year you don't get to file jointly unless you have a qualified child dependent, right? So for most people, children are out of the house. Your spouse passes away, you don't get to file jointly. Like the next year you're filing single. So big difference in the tax bracket. All right, so here we have a widow who, the nice thing, Social Security 101 is if a spouse passes away, the surviving spouse does get to claim the larger of the two benefits, right? So Here we are up to, the widow gets to assume the $2,000 benefit. Many times pensions will have some kind of survivor benefit. 50% is pretty common. Of course, that depends on the pension. But let's just say, this widow wants to maintain the same standard of living, right? In order to get to that same $8,000 a month, now she has to withdraw $4,500 from an IRA. Okay. Now, what happens here? Same $96,000, but look at the total tax. Now we're over $14,000 in taxes. She's going to pay 14.65 effective rate. Increase in tax rate 77%. All right. So what happened here? Of course, like one of the main reasons is now she's filing single, which means you have to pay higher taxes on lower income amounts, right? And then the second thing, if you remember back to provisional income, now because she has to withdraw a larger percentage of her living lifestyle from an IRA instead of Social Security, right? Her Social Security is getting taxed at a higher percentage, right? So something to be aware of. And again, what are the practical things you can do? In my eyes, this is just another reason why you need to be considering Roth conversions early in retirement, right? Because just think if if this couple were to be doing Roth conversions earlier on for maybe 6, 8, 10 years early in retirement, maybe she has enough in a Roth IRA or other investment accounts where instead of withdrawing $4,500 from the IRA, maybe she only needs to withdraw $2,000 from the IRA, and she can take $2,500 from the Roth, right? Like that would increase the flexibility for her, but massively decrease the tax liability. So important to point that out. Okay, so that's it. I just have a quick slide here. Like, I know we always have a nice mix on these webinars of people that we already help. Some of those we already help with taxes. Some we don't, but we also have a lot of viewers that we don't currently help. So if you do want to have a conversation, these are usually some good reasons why we might want to have a phone call. Just if you want to look into making sure you're minimizing taxes, optimizing Social Security. If you do not have a complete retirement plan, you haven't truly tested the strength of your current plan. If like a 2008-9 happens, or even this coronavirus, put pretty good stress test. Just if there's any doubt in your mind, if you think you might be able to possibly be able to do something a little bit better, we'd love to be a second set of eyes and see if we think we might be able to help. Last little point I put here at the end is we don't have a lot of requirements, but we do need you to care about your retirement plan as much as we do. Our team and our advisors, it takes a lot of time to do some of this analysis, and we don't like chasing people around for tax returns, and so we do need you to care if we're going to help. So if you do want to speak with us, what we do, we offer these complimentary. Again, because we have the software to do it, really we just need a tax return, and we can give you your projected 2020 tax map, like where you currently sit for the year. And again, we have the software, so it doesn't take us long to punch in those numbers, and we would be happy to provide that information for you. I think that's it. Gosh, so maybe that went long, Patrick. I mean, again, I could talk about this stuff for really long, all day, multiple days. So it was a struggle trying to package that all into whatever, an hour and 10 minutes. So thank you for hanging around. I don't know if we have time for a couple questions or not, but what do you have there, Patrick?
Yeah, we had a few come in during the presentation that I made a note of, the ones that I think would apply to the most people. We have from Tim, for tax purposes, does it matter what kind of mutual funds I own?
Yes. Yeah, so it does, right? Because yeah, so especially in a broker, right? In an IRA, it won't matter, Tim, but in a like a regular brokerage account or an after-tax account, mutual funds have many different strategies. Some have a lot of turnover, meaning like a lot of trading. Like we don't like those, but a lot of them do. And the problem with a lot of turnover is that that's where you get like that unexpected long-term capital gain distribution, a significant one at the end of the year. And what that could potentially do is, well, worst case scenario, you'd be, close to one of those break points, and it could throw you over. So definitely something to be cognizant of in a taxable account for sure.
And that's a statement. Okay, and then we'll go with the other one that I have here. Roger is wondering, do I need to be aware of my long-term capital gains in brokerage accounts when considering Roth conversions? I'm assuming Roger is referring to non-qualified accounts with brokerage accounts.
Right. Okay, so that's a really good question. And again, the reason we put that disclaimer in the beginning of the webinar is because this is really confusing. Like this, and I think the answer to this question will demonstrate this. But like, I've loosely been throwing around the term income throughout this webinar, and there are all different kinds of income, right? There's adjusted gross income. There is modified adjusted gross income. There's actually two different kinds of modified adjusted gross income. Like one applies to your Medicare premium surcharges. Like there's a different one that applies to healthcare credits from like the marketplace. All right, so Roger, yeah, you definitely need to be aware of long-term capital gains in a brokerage account, because modified adjusted gross income for Medicare purposes, like that includes your long-term capital gains. So like, again, when we were showing that example of like the Medicare spike, where your Medicare could become, $2,500 more expensive for a single year. Like if you realize a capital gain in a brokerage account, like that could do the same thing. That could be the difference of you paying $2,000 or $4,500 for Medicare. So definitely need to be aware of that. Good question, Roger.
And then one more good question here that I think you'll be able to answer pretty briefly, so we don't have to keep people too much longer. Does it matter what time of year the spouse dies to not be able to file jointly?
No. So so you can still file jointly for that year. So for that tax year, you can still file jointly. It's going to be the following year. So, yeah, so no, that doesn't matter. All right. Well, again, thank you for sticking with us. I know this is the longest one ever, but it was hard cramming that all in. Hopefully you found it helpful. And of course, we would be more than happy to help with some of these topics. And yeah, feel free to send us an email, or if you think of additional questions down the road. Yeah, we've got a fun team that is eager to help with tax planning and investment planning and retirement planning. And again, we appreciate you taking the hour and change out of your day. And hopefully we'll see you at the next webinar. So thanks a lot.